A disclaimer, this video is for educational and informational purposes only. The content shared here is based on personal opinions and general financial knowledge. I am not a certified financial advisor. Please do your own research or consult a qualified financial professional before making any financial decisions. The creator of this video is not responsible for any profit or loss incurred based on the information provided. Investments are subject to market risk. 6 trading desks went dark last night. Not closed for the day, not shut down for maintenance. Dark. Emergency protocol activated. Traders sent home mid-shift with NDAs pushed across their desks before they could reach the elevator. Goldman Sachs, JP Morgan, Citigroup, Bank of America, Morgan Stanley, Deutsche Bank, 6 of the most powerful trading operations on Earth, all activating something called Protocol 7B within hours of each other. A protocol that, according to internal documentation that reached me at 2 a.m. this morning, is reserved for systemic counterparty uncertainty events. Let me translate that from banker speak. Systemic counterparty uncertainty means they don't know if the people on the other side of their trades can pay. It means somewhere in the 1.5 quadrillion derivatives market, something broke. A domino fell. And now the institutions that make markets, that provide liquidity, that keep the entire financial system functioning, have stepped back from their screens. When trading desks close voluntarily during market hours, it's news. When 6 close simultaneously under emergency protocol, it's a signal. A signal that the people who know the most about what's happening in financial markets have decided the safest thing to do is nothing. Don't trade, don't take counterparty risk, don't be exposed when the next domino falls. The last time we saw coordinated trading desk shutdowns at this scale was September 15th, 2008. The day Lehman Brothers filed for bankruptcy. The day the global financial system came within hours of complete collapse. That's not hyperbole. That's documented history. Hank Paulson, the Treasury Secretary, later said they were days away from martial law and food riots if the system hadn't been backstopped. And now, 14 years later, the same pattern is emerging. The same institutions, the same protocols, the same eerie silence from official channels. They're not talking, they're not explaining, they're just closed. The question isn't whether something happened last night. The question is what happened and whether we have hours or days before the rest of the world finds out. Welcome to Finance Market News. Before we go any further, before I walk you through the documentation I received and what it means for your money, your investments, and the financial system itself, I need to ask you something. Are you subscribed to this channel? Here's why that matters right now. The information I'm about to share comes from sources inside these institutions. People who reached out because they've seen our previous coverage. People who trust that we'll report accurately instead of burying the story. That only happens because we've built an audience that shares these videos, that engages with them, that makes sources willing to take career-ending risks to get information out. So if you want to keep seeing this kind of coverage, if you want to be informed before the mainstream financial media catches up, before the official press releases are crafted, before the narrative is controlled, hit that subscribe button, turn on notifications. Because what happens over the next 48 to 72 hours could define the financial landscape for the next decade. And drop a comment below. Tell me, have you noticed anything unusual in your brokerage accounts? Delayed trades, unusual error messages, settlement issues? I'm collecting data points from viewers across the country, and your observations might confirm patterns we're seeing from institutional sources. Now let's talk about what happened last night, and why 6 of the world's largest banks decided the safest place to be was away from their trading desks. To understand why trading desk closures matter, you need to understand what trading desks actually do. Not the simplified version, the real version. The version that explains why their absence can cascade through the entire financial system. Major bank trading desks serve multiple functions. They trade for the bank's own account, what's called proprietary trading. They facilitate client transactions, acting as intermediaries between buyers and sellers. They make markets, providing liquidity by standing ready to buy or sell at quoted prices. That last function, market making, is crucial. When you buy a stock through your brokerage, you're probably not matched directly with another individual seller. Instead, a market maker steps in. They sell you the stock from their inventory, then later find a natural seller to replenish. This happens in milliseconds. It's invisible to retail investors, but it's what allows markets to function smoothly. Now imagine the market makers step away. Suddenly, there's no one standing ready to buy or sell. Bid-ask spreads, the difference between what buyers will pay and sellers will accept, widen dramatically. In extreme cases, trading simply stops because there's no one to take the other side. This happened in March 2020 during the COVID panic. Market makers pulled back. Treasury markets, the deepest and most liquid in the world, became dysfunctional. The Federal Reserve had to intervene with trillions of dollars of emergency liquidity. But trading desks do something even more important than making markets in stocks. They manage derivatives. Derivatives are financial contracts whose value derives from some underlying asset. Options, futures, swaps, complex structured products with names most people never hear. The derivatives market is enormous. The Bank for International Settlements estimates the notional value of outstanding derivatives at approximately $700 trillion. Some estimates, including certain credit derivatives and custom contracts, push the total above $1 quadrillion. That's not a typo. Quadrillion with a Q. Now, notional value isn't the same as actual risk. If I have a $1 million interest rate swap, the notional value is $1 million, but my actual exposure might only be a few percentage points of that, depending on interest rate movements. But here's the problem. These derivatives create webs of interconnection between financial institutions. Bank A has a swap with Bank B. Bank B has offsetting positions with Bank C. Bank C has exposure to Bank A. Everyone owes everyone else, and the whole system depends on everyone being able to pay. This interconnection is what regulators call counterparty risk. If one major institution fails, it can't pay its obligations. That means its counterparties suddenly have unexpected losses. If those losses are large enough, they can't pay their obligations. The cascade continues. Lehman Brothers had about $35 billion in assets when it failed, but because of derivative interconnections, its failure nearly collapsed the global financial system. The losses rippled through counterparties, through money market funds, through commercial paper markets, through the real economy. Protocol 7B, the emergency protocol referenced in the documentation I received, specifically addresses counterparty uncertainty. It's activated when an institution determines that the creditworthiness of its trading counterparties is unclear. In plain English, they don't know who can pay and who can't. When you don't know who can pay, the safest response is to stop trading entirely. Don't take new positions. Don't increase exposure. Reduce risk wherever possible. 6 major banks reaching this conclusion simultaneously suggests they're all seeing the same thing. The same counterparty concerns. The same uncertainty about who's still solvent. The documentation I received includes references to specific stress indicators. Credit default swap spreads. These are essentially insurance policies against default. When CDS spreads widen, it means the market is pricing in higher default risk. According to the documentation, CDS spreads on several major financial institutions spiked between 4 p.m. and 8 p.m. yesterday, outside normal trading hours, in overseas markets. Repo market rates. The repo market is where banks borrow short-term using Treasury securities as collateral. When repo rates spike, it indicates liquidity stress. Banks are having trouble borrowing. According to the documentation, overnight repo rates exceeded the Federal Reserve's target range by over 200 basis points in certain transactions last night. Federal Reserve emergency facility usage. The Fed has several standing facilities that banks can access for emergency liquidity. The Bank Term Funding Program, created during the regional bank crisis of 2023, is one. According to the documentation, multiple institutions access these facilities in the hours before the trading desk closures. When banks are accessing emergency facilities while simultaneously closing trading desks, they're managing a crisis. They're securing liquidity while reducing exposure. They're battening down hatches. The question is, what storm do they see coming that the rest of us don't? Let me walk you through the timeline as I've been able to reconstruct it from multiple sources. 3:47 p.m. Eastern yesterday. An unusual block trade hits the S&P 500 futures market. $4.2 billion notional value sold in a single transaction. The seller is not identified, but the size suggests a major institution. This kind of trade doesn't happen in normal conditions. When you want to sell $4 billion of anything, you do it gradually to avoid moving the market against yourself. A single block suggests urgency. Someone needed to reduce exposure immediately, regardless of price impact. 4:15 p.m. Eastern, U.S. markets close, but futures markets continue trading. In the first 15 minutes of after-hours trading, S&P futures dropped 1.2%. Not catastrophic, but notable, given the size of the move and the absence of any news catalyst. 4:45 p.m. Eastern. The first internal communication goes out at Goldman Sachs. According to a source who forwarded the message, the subject line is Trading Floor Status Update. The message instructs certain trading desks to complete position reconciliation and prepare for potential operational adjustments. Position reconciliation means accounting for all open trades, making sure the books are accurate. This is normal at end of day, but the language about operational adjustments is unusual. 5:30 p.m. Eastern. Similar communications go out at JP Morgan and Morgan Stanley. The language varies slightly, but the substance is similar. Position reconciliation, operational adjustments, stand by for further guidance. 6:15 p.m. Eastern. Credit default swap. Spreads on European financial institutions begin widening in Asian trading. Deutsche Bank CDS spreads increase 45 basis points in less than an hour. UBS widens 38 basis points. Barclays widens 52 basis points. CDS spreads widening means the market is pricing in higher default risk for these institutions. Something is making traders nervous about European bank solvency. 7 p.m. Eastern. The Federal Reserve's emergency lending window shows unusual activity. I cannot confirm specific institutions or amounts, but multiple sources indicate that borrowing exceeded typical levels by a significant margin. The Fed's emergency facilities exist precisely for moments like this. When institutions need liquidity and can't get it through normal market channels, the Fed steps in as lender of last resort. Heavy usage suggests normal channels are stressed. 7:45 p.m. Eastern. Deutsche Bank's New York trading operation receives instructions from Frankfurt. According to a source in their risk management department, the instruction is to reduce gross exposure across all books and prepare for extended reconciliation procedures. Reducing gross exposure means unwinding positions, selling what you own, buying back what you've sold short, flattening the books. This is what you do when you're worried about what tomorrow might bring. 8:30 p.m. Eastern. Protocol 7B is formally activated at Goldman Sachs. This is the internal emergency designation for counterparty uncertainty events. The protocol includes suspension of proprietary trading, restriction of new client transactions, to liquidation only mandatory position reporting, to risk management, physical presence requirements for senior traders. The physical presence requirement is telling. In an age of remote work, requiring traders to be physically present suggests they need real-time supervision. They need people in the room making decisions together. 9:15 p.m. Eastern. Similar protocol activations occur at JP Morgan, Citigroup, Bank of America, and Morgan Stanley. The timing is staggered by minutes, not hours. Coordinated response to a shared concern. 10 p.m. Eastern. Trading desk staff at all 6 institutions are released from their floors. According to multiple sources, they're asked to sign updated confidentiality agreements before leaving. The agreements specifically prohibit discussion of operational status changes and client position information. NDAs at the door is not normal. It suggests the institutions are acutely concerned about information leakage. They don't want traders talking to each other, to clients, to the press. 11:30 p.m. Eastern. Asian markets open. Volume is notably light in the first hour. Large institutional flows that normally appear are absent. The market makers who typically provide liquidity seem to be missing. The absence is noticed. Bloomberg terminals start lighting up with trader chats, asking what's happening. Why are spreads so wide? Where are the bids? 2 a.m. Eastern. The documentation reaches me. A packet of internal communications, risk management memos, and protocol activation confirmations. Sent from an encrypted email address I've never seen before. The sender identifies themselves only as concerned about what happens Monday. I've spent the hours since verifying what I can, cross-referencing with other sources, checking publicly available data points. The timeline is consistent. The documents appear authentic. Something happened last night, something significant enough to trigger coordinated emergency responses at 6 of the world's largest financial institutions. And as of this recording, not a single official statement has been released. No press releases, no regulatory filings, no explanation whatsoever, just silence and closed trading desks. The documents I received don't identify a single trigger. They reference elevated counterparty uncertainty and anomalous credit market conditions, but they don't name a specific institution or event. Based on the available evidence, let me walk through the most likely possibilities. Possibility 1, major derivatives, counterparty failure. Somewhere in the derivatives web, a major counterparty has either failed or is imminently failing. The 6 banks that closed their desks are all major derivatives dealers. They're all interconnected. If any one of them had a significant exposure to a failing counterparty, they would all want to know their own exposure before trading further. Who could be the failing counterparty? It's not one of the 6. If Goldman Sachs were failing, they wouldn't be methodically closing trading desks and having people sign NDAs. They'd be in full crisis mode. It could be a large hedge fund. Several hedge funds have derivatives exposure in the hundreds of billions. If a major fund like Citadel, Millennium, or Bridgewater encountered sudden catastrophic losses, their prime brokers and derivatives counterparties would need to assess exposure immediately. It could be a foreign bank, not included in the 6. Credit Suisse collapsed last year. What if another European institution is in similar distress? The CDS spread widening on European banks suggests the market sees something. It could be a sovereign entity. Several countries have significant derivatives exposure related to currency hedging and debt management. A sovereign default or near default could cascade through the derivatives system. Possibility 2, Treasury market dislocation. The U.S. Treasury market is the foundation of global finance. Treasury securities are used as collateral for trillions of dollars of transactions daily. If something goes wrong in the Treasury market, everything downstream breaks. There have been warning signs for months. Treasury auctions have been receiving weaker demand. The term premium, the extra yield investors demand for holding longer-term treasuries, has been rising. Liquidity in the Treasury market has been declining. The $4.2 billion S&P futures sale I mentioned earlier could indicate someone desperately raising cash. If they were also selling treasuries, it could have created dislocations in both markets simultaneously. Treasury market stress would explain why the Federal Reserve's emergency facilities saw heavy usage. Banks might be bringing treasuries to the Fed because they can't sell them in the open market at acceptable prices. Possibility. 3. Commercial real estate collapse. U.S. commercial real estate is in serious trouble. Office vacancy rates are at record highs. Property values have collapsed 30 to 40% in major markets. Banks hold approximately $2.7 trillion in commercial real estate loans. Regional banks have already failed from commercial real estate exposure. Silicon Valley Bank, Signature Bank, First Republic. What if a major bank's commercial real estate portfolio is worse than disclosed? Banks don't mark real estate loans to market the way they mark trading positions. They can hold loans at inflated values until they actually default, but eventually, reality catches up. If a major bank suddenly had to recognize massive losses on commercial real estate, their trading counterparties would want to reassess creditworthiness. That could trigger exactly the counterparty uncertainty referenced in the protocols. Possibility 4, interest rate derivatives unwind. When interest rates were near zero, institutions loaded up on interest rate derivatives. Many of these positions assumed rates would stay low. When rates rose dramatically in 2022-2023, these positions generated enormous losses. Most of these losses were absorbed, written down, hedged away, but not all. Some institutions may have been rolling positions forward, hoping for rate cuts that would bail them out. The Federal Reserve has been slower to cut rates than many expected. If an institution's rate derivatives position is underwater and they're running out of time, that could trigger exactly what we saw last night. Possibility 5, something we don't know about. The financial system is complex beyond comprehension. There are products, positions, and exposures that don't appear in public filings. There are concentrations of risk that regulators miss. There are connections between institutions that aren't visible until they break. The 2008 crisis was triggered by subprime mortgages. But most people hadn't heard of subprime mortgages until the crisis was already underway. The risk was hiding in plain sight, disguised by complex securitization and rating agency failures. What risk is hiding now? What position is too big? What connection is too fragile? The honest answer is, I don't know. The people inside these institutions may not fully know. The interconnection is so vast, the complexity so extreme, that no one has complete visibility. What I do know is this: 6 major banks don't activate emergency protocols simultaneously for nothing. Something triggered this response, something serious enough to warrant coordinated shutdown of some of the most important trading operations in the world. We'll find out what it was. The only question is whether we find out through orderly disclosure or through market panic. Let me take you back to moments in history when similar patterns emerged. Because what we're seeing isn't unprecedented. It's a pattern that repeats before every major financial crisis. September 14th, 2008, Lehman Brothers. On Sunday, September 14th, Lehman Brothers executives were in emergency meetings with regulators and potential acquirers. The firm was failing. Its counterparties were refusing to trade with it. Its funding was evaporating. That Sunday night, trading desks at every major bank went into emergency mode. Not because they were failing, but because they didn't know what Lehman's failure would mean for them. How much did they have at risk with Lehman? How much did their clients have at risk? How would markets open Monday morning? The Monday open was chaos. Stock futures indicated a 300-point drop before markets even opened. When trading began, the Dow fell 500 points, the largest single-day point drop in history at that time. But the real damage was in credit markets. Money market funds that held Lehman paper broke the buck. Commercial paper markets froze. Banks stopped lending to each other. The pattern we saw last night, coordinated trading desk closures, emergency protocol activations, heavy use of Fed facilities, is the same pattern we saw that Sunday night, March 16th, 2008. Bear Stearns. 6 months before Lehman, Bear Stearns collapsed. On that Sunday, JP Morgan agreed to acquire Bear for $2 per share, backed by Federal Reserve guarantees. The days before the rescue showed the same pattern, trading desks pulling back, counterparties refusing to trade, emergency meetings through the weekend. Bear Stearns' collapse was a warning shot. The system was fragile. It would only take one more shock to break it entirely. Lehman was that shock. September 2019, repo market crisis. This one is less well known because the Fed intervened before it became a full crisis. In September 2019, overnight repo rates spiked from around 2% to nearly 10%. This meant banks were having trouble borrowing short-term, even against Treasury collateral. The spike indicated severe liquidity stress somewhere in the system. The Fed responded with emergency repo operations, injecting hundreds of billions of dollars into the market. The crisis was contained, but it revealed fragility. The plumbing of the financial system, the short-term funding markets that keep everything running, could seize up without warning. The heavy Fed facility usage reported last night echoes that 2019 episode. Institutions seeking emergency liquidity suggests the normal channels aren't working. March 2020, COVID crash. When COVID panic hit markets in March 2020, we saw another coordinated trading desk response. But this time, instead of closing desks, institutions widened spreads dramatically. They were still making markets, but at prices that reflected extreme uncertainty. Treasury markets became dysfunctional. The basis trade, a popular hedge fund strategy, collapsed, generating massive losses. The Fed ultimately intervened with unlimited quantitative easing and multiple emergency lending facilities. The COVID response showed that the Fed can prevent financial collapse if it acts decisively. But it also showed how quickly markets can break down when fear takes hold. March 2023, regional bank crisis. Just last year, Silicon Valley Bank, Signature Bank, and First Republic all collapsed within weeks. The trigger was a classic bank run. Depositors fleeing institutions they feared were insolvent. But the pattern that preceded the visible crisis was similar to what we saw last night. Credit default swaps on regional banks widened. Trading desks pulled back from making markets in regional bank securities. Liquidity evaporated. The crisis was contained through FDIC intervention, Federal Reserve lending facilities, and hastily arranged acquisitions. But it came closer to breaking than most people realize. If SVB had failed without intervention, if depositors had fled to other regional banks, if the panic had spread to larger institutions, we might have seen 2008 again. The regional bank crisis showed that the system remains fragile, that confidence can evaporate quickly, that the tools used in 2008 are still necessary today. What the patterns? Tell us. Every financial crisis follows a similar trajectory. Hidden stress builds. Problems develop inside institutions, invisible to the public. Insiders notice. Trading desks see counterparties behaving strangely. Credit spreads widen. Liquidity becomes difficult to access. Defensive actions. Institutions reduce exposure, access emergency facilities, prepare contingency plans. Public awareness. Eventually, the stress becomes visible. Headlines appear. Markets react. Crisis or intervention. Either the system breaks or authorities intervene with enough force to restore confidence. We appear to be at stage 3 right now. Defensive actions have been taken. The question is, how long before stage 4? Since the documentation reached me early this morning, I've been working my contacts inside the financial system. People I've spoken with over years of covering these markets. People who know what normal looks like and can recognize when things are abnormal. And let me share what I'm hearing, with identifying details removed to protect sources. From a senior risk manager at one of the 6 banks, the order came from the top, not the trading floor head, not the division head, the CEO's office. When you see that, when the CEO is personally directing trading desk operations, it's not routine. Something has their attention. The specific concern is counterparty exposures in the credit derivatives market. We're trying to figure out who's on the other side of certain trades and whether they'll be there Monday morning. The answer isn't clear. From a trader at a major hedge fund, we got calls from 3 of our prime brokers yesterday evening asking about our positions. They wanted confirmation of our NAV, our liquidity, our margin availability. It felt like they were checking if we were the problem. When prime brokers start calling clients to verify their health, it means they're worried about someone. They're trying to figure out who's weak before the weakness becomes public. From a former Federal Reserve official, the Fed facilities are supposed to be used. That's why they exist. But the pattern of usage matters. If multiple institutions are hitting the window simultaneously, it suggests they all see the same risk. In 2019, the repo spike was a liquidity issue, not a solvency issue. The Fed fixed it with liquidity injections. If this is a solvency issue, liquidity won't be enough. You need to identify the sick institution and either save it or let it fail. Right now, everyone's trying to figure out, is this liquidity or solvency? The answer determines everything. From an analyst at a major rating agency, we've been told to prepare for potential rapid reviews of several financial institutions. The names weren't specified, but the instruction was to have staff available through the weekend. Our rating agencies don't staff up for weekends unless they expect to need to change ratings quickly. A downgrade of a major financial institution could trigger covenant violations, margin calls, counterparty concerns. It becomes a self-fulfilling prophecy. From a regulatory attorney, the timing of this Friday evening suggests they're trying to manage information flow. Friday evening announcements give institutions the weekend to prepare before markets open Monday. If something significant is going to be announced, Sunday evening is the likely timing. That's when you'd see emergency merger announcements, regulatory interventions, Fed statements. The pattern from 2008 was Sunday night announcements, Monday morning chaos. Anyone who remembers that pattern is watching Sunday very carefully. From a treasury market specialist, there were transactions last night that didn't make sense. Large blocks moving at prices that suggest distressed selling. Someone was raising cash and they needed it immediately. And when you see that kind of selling in treasuries, the safest asset in the world, it means the seller's alternatives are gone. They can't borrow, they can't sell other assets. Treasuries are the last resort. That kind of distressed selling happened right before Bear Stearns collapsed. It happened before Lehman. It's a warning sign that someone is in serious trouble. From a cryptocurrency exchange executive, we've seen unusual inflows over the past 12 hours. Institutional-sized transfers into Bitcoin and stablecoins, not retail. This is sophisticated money moving into assets outside the traditional banking system. When traditional finance players start moving to crypto, especially suddenly and at scale, they're hedging against something in the traditional system. They're looking for an exit. The picture these sources paint is consistent. Something is wrong. Someone is in trouble. The institutions are circling, trying to identify the weak link, trying to protect themselves from contagion. No one I've spoken with knows exactly what happened or who's at risk. But everyone agrees that the coordinated response suggests the problem is serious, systemic, and not yet public. Given everything we've discussed, what are the practical implications for ordinary people? What should you be doing right now? I want to be clear, I'm not a financial advisor. I don't know your specific situation. What follows is educational information, not personalized advice. But let me walk through considerations that might be relevant. Your bank accounts. If there's a major bank failure, your deposits are protected by FDIC insurance up to $250,000 per depositor, per bank. This coverage is held through every crisis since the FDIC was created. But there's a catch. FDIC resolution can take time. When SVB failed, depositors got access within days because of emergency interventions. But in a larger crisis, with multiple institutions failing, the process could take longer. Having funds spread across multiple institutions provides redundancy. Having some cash outside the banking system provides immediate access regardless of what happens. I'm not suggesting you withdraw everything. I'm suggesting that concentration in a single institution creates single point of failure risk. Your brokerage accounts. Securities held in brokerage accounts are protected by SIPC insurance up to $500,000, including up to $250,000 in cash. If your broker fails, your securities should be transferred to another institution. But again, resolution takes time. During the transfer, you might not be able to trade. You might not have immediate access to funds. If you have significant holdings, understanding your broker's financial health matters. Large brokers affiliated with major banks carry the same counterparty risks we've been discussing. Smaller, well-capitalized brokers with conservative business models might actually be safer. Your investment positions. If markets open Monday with significant stress, prices will move, potentially dramatically. During 2008, the S&P 500 ultimately fell 57% from peak to trough. During the COVID crash, it fell 34% in about a month before recovering. If you're holding positions you can't afford to lose, the next 48 hours might be your last opportunity to reduce risk before potential volatility. This is not a prediction. I don't know what happens Monday. But the signals we're seeing suggest elevated probability of market stress. Managing risk accordingly is prudent. Physical cash. Every financial crisis in modern history has involved some form of access restriction. ATM limits in Cyprus, bank holidays in the Great Depression, transaction delays during system stress. Having physical cash sufficient to cover a few weeks of expenses provides optionality. If electronic systems are disrupted, if banks impose withdrawal limits, cash lets you continue transacting. How much? That depends on your circumstances. Some people keep a month of expenses in cash, others keep more or less. The point is having some buffer against system disruption. Precious metals. Gold and silver have historically served as crisis hedges. They're physical assets with no counterparty risk. They don't depend on any institution's solvency. In 2008, gold initially fell with other assets as institutions raised cash. But then it recovered and ultimately rose significantly as the crisis unfolded and central banks responded with monetary expansion. I'm not saying load up on gold. I'm saying understanding your exposure to assets that exist outside the financial system is relevant when the financial system shows stress. Cryptocurrency, Bitcoin, and other cryptocurrencies held in self-custody represent another category of assets outside traditional finance. They don't depend on banks. They don't have counterparty risk. The cryptocurrency sources I mentioned earlier are seeing institutional inflows. Sophisticated money appears to be hedging. This is not an endorsement. Crypto is volatile and comes with its own risks. But it represents optionality outside the traditional system. Information. The most valuable thing you can have right now is information. Being aware of what's happening, understanding the implications, and making decisions ahead of the crowd. Most people will learn about this Monday morning when they wake up and check headlines. By then, if there's significant stress, markets will have already moved. The opportunity to position will have passed. You're watching this now. You have time they won't have. Use it wisely. Do nothing. Doing nothing is also an option. It's possible that this situation resolves over the weekend, that whatever triggered the emergency protocols is contained, that Monday opens normally. Financial systems have more resilience than pessimists expect. Regulators have learned from 2008. Central banks have tools they didn't have before. Maybe this is a false alarm. Maybe the trading desks reopen Monday like nothing happened. Maybe I'm over-concerning. But the downside of preparing for a crisis that doesn't happen is minimal. The downside of not preparing for a crisis that does happen is potentially catastrophic. The asymmetry favors preparation. Let me walk through the possible scenarios for the next 72 hours and what each would mean. Scenario 1, quiet resolution. The problem, whatever it is identified and contained over the weekend. A distressed institution is acquired, bailed out, or otherwise stabilized. Trading desks reopen Monday. Markets show mild stress, but no crisis. This is the best case. It means the system worked as intended. Early warning signs triggered appropriate responses. Damage was prevented. If this happens, there will probably be minimal public disclosure. The institutions involved won't want to admit there was ever a problem. You'll see vague references to technical issues or operational adjustments. The real story will emerge months or years later, if ever. Scenario 2, managed announcement. A significant problem is announced Sunday evening. Perhaps a major institution needs emergency support. Perhaps a merger is hastily arranged. Perhaps the Fed announces new emergency facilities. Markets open Monday with significant volatility, but the announcement provides clarity. Investors know the problem and they know the response. Prices adjust, but the system continues functioning. This is similar to what happened with Bear Stearns. Sunday evening announcement, Monday morning volatility, eventual stabilization. Scenario 3, disorderly crisis. The problem is worse than anticipated. The weekend isn't enough time to arrange a solution. Markets open Monday without clarity, without a response plan, without confidence. In this scenario, we could see cascading failures, counterparties pulling credit, fire sales of assets, market makers withdrawing, liquidity evaporating. The Fed would ultimately intervene, but the damage would already be done. Like Lehman, where the failure on Monday led to weeks of chaos before stabilization. This is the scenario everyone is trying to avoid. But avoiding it requires identifying and solving the problem before Monday. If that doesn't happen, disorderly crisis becomes possible. Scenario 4, the unknown. Financial crises rarely unfold according to anyone's script. The actual sequence of events may be something none of us anticipate. There may be geopolitical dimensions we don't see, sovereign exposures, currency crises, international coordination or lack thereof. There may be technical failures, trading systems that don't function properly under stress, settlement failures that cascade unexpectedly. There may be political complications, regulators who disagree on the response, congressional interference, presidential involvement. The unknown is, by definition, unknowable, but it's worth remembering that actual crises are always messier than theoretical ones. What to watch over the next 72 hours, pay attention to: Federal Reserve announcements. Any emergency statement, any new facility, any unscheduled meeting indicates serious response. Sunday evening news. That's when coordinated announcements are typically made. Watch for merger announcements, regulatory statements, institutional disclosures. Asian market opens. Sunday evening Eastern Time is when Asian markets begin trading. If there's significant selling or volatility in Asia, it suggests the problem is becoming public. Credit default swap spreads. If CDS spreads continue widening, it means the market is pricing in greater default risk. Bloomberg or other financial terminals will show this data. Treasury yields. Flight to safety typically pushes Treasury yields down. If yields are dropping sharply, it means money is fleeing risk assets for safety. Cryptocurrency prices. Paradoxically, a spike in Bitcoin and crypto could indicate traditional finance stress. Money flowing to alternatives suggests loss of confidence in the traditional system. Official silence. If we reach Sunday evening with no announcements, no explanations, no official statements, that's concerning. It might mean they don't have a solution yet. It might mean Monday opens without a plan. Let me zoom out from the immediate situation and talk about what this means in a larger context. For 15 years since the 2008 crisis, the global financial system has operated under an implicit guarantee. When things break, central banks will fix them. The Fed will provide liquidity. Troubled institutions will be rescued. Markets will be backstopped. This guarantee has allowed extraordinary risk-taking. Institutions know that if their bets fail, if their leverage proves excessive, if their models were wrong, the central bank will catch them. Moral hazard, the economists call it, the tendency to take more risk when you don't bear the full consequences of that risk. The derivatives market has grown from $100 trillion in 2000 to over $700 trillion today. Banks have more complex interconnections than ever before. The system has become more fragile, even as it's become larger. Every rescue, every intervention, every guarantee makes the next crisis potentially larger, because the risk-taking enabled by the guarantee exceeds the capacity of the guarantee itself. We saw this with Lehman. The government decided not to rescue Lehman, partly because they were exhausted from rescuing Bear Stearns 6 months earlier. The result was near systemic collapse. They learned from that. They rescued everyone after Lehman, AIG, the money market funds, eventually the entire banking system through TARP. But each rescue was larger than the last, and each rescue set the stage for more risk-taking, for more complexity, for more interconnection. What happens when the required rescue exceeds what central banks can provide? What happens when the problem is so large that printing money and providing liquidity isn't enough? We may not be at that point. The Fed's balance sheet is $7 trillion. They can still create money. They can still backstop the system, but we're closer to the limits than we've ever been. Interest rates are higher, which means the cost of intervention is greater. Government debt is $34 trillion, which limits fiscal response. Inflation has constrained the Fed's ability to print freely. The margin for error has narrowed. The consequences of getting it wrong have grown. What we're witnessing this weekend may be manageable. The institutions may find a solution. The Fed may provide sufficient support. Monday may come and go without disaster, but the fundamental fragility remains. The derivatives mountain is still there. The interconnections are still complex. The moral hazard is still embedded. If not this weekend, then some future weekend. If not this crisis, then the next one. Eventually, the system's complexity exceeds the capacity to manage it. That's not pessimism, that's just math. Systems that become too complex eventually fail. History teaches this lesson repeatedly. What individuals can do is limited. We can't reform the financial system. We can't reduce derivatives exposure. We can't eliminate counterparty risk. But we can position ourselves to survive system failure. We can hold assets outside the system. We can maintain liquidity. We can avoid single points of failure. We can understand that the system is fragile, that rescues have limits, that complexity has consequences. And we can watch, learn, and prepare. Because what happens this weekend is a preview. If not the crisis itself, then the shape of the crisis to come. Let me bring this back to where we started. 6 trading desks went dark last night. Goldman Sachs, JP Morgan, Citigroup, Bank of America, Morgan Stanley, Deutsche Bank. They activated Protocol 7B, Emergency Counterparty Uncertainty Procedures. They accessed Federal Reserve facilities. They sent traders home with NDAs. This doesn't happen for routine reasons. This happens when something breaks, or is about to break. This happens when the people who understand the financial system best decide the safest thing to do is step away from their screens. I've shown you the timeline. I've walked through the possible triggers. I've shared what sources inside these institutions are saying. I've explained the historical patterns. What I can't tell you is exactly what happens next. Whether this resolves quietly over the weekend, whether there's a Sunday evening announcement, whether Monday opens in chaos, what I can tell you is that the signals are serious. The patterns are concerning. The people who know the most are acting like something is wrong. In the next 48 to 72 hours, we'll know more. The situation will either stabilize or escalate. The problem will either be solved or will become public. What you do with this information is up to you. You can dismiss it as alarmism. You can wait and see. You can take steps to reduce exposure and increase resilience. I've told you what I know. I've told you what I'm seeing. The decision is yours. What I will say is this. The time to prepare for a crisis is before it's visible to everyone. Once it's on CNBC, once it's in the headlines, once the crowd realizes what's happening, it's too late to position. You're ahead of that curve right now. Use that advantage wisely. Drop a comment below. Tell me what you're seeing in your accounts, your banks, your brokerages. The collective intelligence of this audience has value. Subscribe if you haven't. Hit the notification bell. I'll be monitoring this situation through the weekend and providing updates as information becomes available. This is Finance Market News. Thank you for watching. The trading desk's closed for a reason. We're about to find out what it is. I'm recording an update video tonight that will go live Sunday morning. It will include any new information that emerges overnight and over the weekend. Subscribe and turn on notifications to see it the moment it drops. And if you're watching this Sunday or later, check the description for links to follow-up videos covering what actually happened. Stay informed, stay prepared. See you in the next one.